So there's two types of businesses here that we need to talk about: merchandisers and manufacturers. We're going to be going a lot into manufacturing in this class because it's more complex. In financial accounting, we talked a lot about merchandisers. So what is a difference? A merchandiser is like your Walmart or your Costco. They buy something that's already finished and then they sell it. Or Amazon's a good idea of an example of a merchandiser as well. They're not building their own products. Most of the time, they're not building their own products. They're just buying stuff that's already completed and then reselling it. So we also call these resellers. That takes a different skill set than a manufacturer, right? Like getting products and marketing them to individuals and getting them to the end user is complex and expensive. Manufacturers, on the other hand, they buy raw materials and produce the finished goods. So you can think of a manufacturer as they're changing raw steel, like raw ores, into steel beams. And then they send that and then they create that and eventually make that into a bike. And then they send that to the merchandise or who buys the finished good and then sells it to the person who wants to use the bike. There's this thing called vertical integration, which we'll go into the future, where some companies want to be both, right? They want to build their own goods and then sell it, but then some companies don't want to do that. So we'll go into that. We're really going to be focused on manufacturing here. And so a manufacturer's balance sheet is different than a merchandiser's. It's more complex. It doesn't just have inventory. We have inventory broken out into these three concepts: raw materials, work in process, and finished goods. Another thing you have to memorize, right? So we have all our different types of costs, and then we have our different types of inventory for a manufacturer. Raw materials is stuff we have not processed yet. Materials we have not processed. That includes direct and indirect materials. Direct being like ores and whatnot, and then indirect could be like a screw. Work in process inventory is something we've started, a project we've started but hasn't been completed. It needs either materials or labor to complete. Then finished goods is inventory that was ready to be sold or shipped. So it does not need any more raw material or direct labor. So it doesn't need direct labor or direct material to be processed or factory overhead. And all of that's also reported on financial accounting statements. So here's a difference between balance sheets for a merchandiser and a manufacturer. So a merchandiser just has merchandise inventory. A manufacturer is going to have the breakout of raw materials, work in process, and finished goods. And you're going to need to know that. And we're going to talk about how you develop that and how you flow all of those products over time. And so how do we compute the cost of goods sold for a manufacturer and for a merchandiser? We learned merchandising before in the last class, but this will be a refresher. You have your beginning inventory plus whatever you purchased minus your ending inventory equals your cost of goods sold for a merchandiser, right? So whatever you started with whatever you bought less whatever you sold is your cost of goods sold. And then you have your FIFO, LIFO methods or weighted average and all that fun stuff. Manufacturer, you have your beginning finished goods, anything you built or manufactured less your ending finished goods. So you're gonna have to memorize these two separate formulas. And so this is just the math. So you can see how it might differ slightly. Beginning finished goods, beginning merchandise, and ending finished goods. And so this manufacturing has a flow, right? We start with our raw materials, our direct materials, and we have beginning. So we'll be tracking all this separate because we need to know how much we have in order to know how much we build. And so this is going to be a lot of exercising our ability to track information and process it. So if you liked inventory accounting and financial accounting, you're going to like this class a lot. If not, there's going to be a lot of this tracking and it's pretty challenging, right? So you're going to have to keep organize a lot of this information. We start with raw materials and then whatever we purchase, so our beginning and our whatever we purchased. And if we use the direct materials, it flows through our production activities, which is our work in process. So that includes any materials we used, our direct labor, and any factory overhead, like electricity that's being used to make these products. And anything that we started working on, or we were continuing working on from the last period. All of that, whenever it's completed, goes to our goods manufactured, which is added to our finished goods inventory. And if it's sold, then it goes to our cost of goods sold. If it isn't sold, or if it's incomplete, it stays on our balance sheet. That's kind of the flow. So the concept here is like, really think about it practically. We have our raw stuff. That's always going to be our direct material sitting in our unfinished, our raw materials inventory. Then once we start working on it, it's in our work in process. And anything that goes into it until it's completed is in our work in process. Then once we actually have a product for sale, that's in our finished good. And that's going to go into our cost of sales once we sell it. So there's this whole flow. What's confusing here is we're capitalizing the cost of labor, right? So if I am building a product, I am not expensing, like I am not an expense, right? If I'm making $100 a day, or if I'm paying that person $100 a day, that $100 a day is going to be increasing the cost of the product. So we can track how expensive the product is. And then you expense that when we sell the product, right? So it's a timing difference. So that salary, it's not a salaries expense on the book. It's an inventory cost. That's very different, right? So we can track the cost of the product. If we don't do that, then we create this huge issue where we can't track the costs. Think about it this way. Another example is I've advised like some Uber drivers, or I've talked to people about this, where people don't realize that driving for Uber can actually cost more down the road than you actually make. And the reason is because of this. Like Uber Eats or just driving for Uber is because people aren't capitalizing their costs. They're not realizing that, hey, every mile I drive is about 50 cents of maintenance. Plus I have my gas that I'm charging towards it. Like all of that's going towards every delivery I have. And then if I actually, even though I don't see that directly because some, maintenance happens in batches, you don't spend $100 a month on maintenance, you spend $1,000 once a year or something like that. Then you aren't able to articulate, you aren't able to define how much you're actually making a month just because there's a timing difference. And so that we're doing the same with production here, is how much labor is actually going into it. And then tracking that with a product sold. Any questions so far? Okay. So there's schedules we can create in order to summarize and make this information more useful. So if we start with our direct materials, we add our direct labor and our factory overhead, we get our total manufacturing costs. This makes sense, right? Our total manufacturing costs are just all the materials we use plus the labor plus overhead. Then if we add in our beginning work in process, we also call this WIP, by the way. Work in process acronym is WIP, W-I-P. And then subtract out what was in our ending, we have cost of good manufactured. So we're saying how much cost did we use? What are our total costs? Add in whatever we started with, subtract out whatever we ended with, and then this is the cost of everything that was actually manufactured in the period. These are all formulas you have to memorize, or at least understand. And then this is how it's tracked. So I want you to walk through this. I'm not going to walk through this. There's so many schedules, we're not going to have time. But the whole concept here is we start with raw materials. We figure out how the raw materials that are purchased, and then this is how many we are available for use. We subtract out whatever was at the beginning, and then we can get direct materials actually used, or what was at the end, and we get the materials actually used. You add in your direct labor. You figure out all the different factory overhead costs that we talked about that you have to allocate to the products, and to get your total manufacturing costs. So this is just a blown up version of what we've talked about, right? Your direct materials, direct labor, and factory overhead. And then this is the breakout of how do we get to what was actually used in the period. And then we add all that to get the total manufacturing costs. And then you have to do the math of what we talked about previously to get the cost of good manufactured, right? Add the work in process inventory at the beginning and subtract out the end. that's just the example. Here's another flow that might be useful for you to understand is your cost of good manufacturers from the cost of goods sales report or manufactured. It's going to flow through to your income statement, right? That's your cost of, instead of cost of sales, we have the cost of good manufactured for manufacturing companies. And then anything remaining, our ending finished goods get transferred over to our finished goods inventory on our balance sheet. And anything still in process gets transferred over to our work in process inventory on our balance sheet. So we have this internal schedule called this cost of good manufactured, and that's what we transferred to our GAAP-based financial statements. Lastly, we'll just talk about some trends. This is a pretty new area of accounting. Right? I mean, accounting has a lot of history, but it continues to evolve. And so companies like Amazon have completely changed the way that we have to track information. It includes the fact that we're a global economy, that our amount of transactions are just completely changed, the quantity and frequency of them, and that customers, there's a much higher customer orientation. So we have to actually track how happy customers are for the products that we're purchasing. One of the biggest things you're going to see too are lean practices, where companies now, like Toyota made this famous in recent history, are making cars when customers order them, rather than what happened in previous history was you just make a bunch of product and then sell it. Now the demand leads the supply, where when there's demand, then the company produces it. Sorry, I see a question from Michelle. Yes.
Which one is credit and debit on the raw material?
Yeah, raw materials, it's going to be, they're all debit based. These are all inventory accounts, right? So anything that's going to be on our balance sheet is going to be a debit. Our raw materials, our work in process, and finished goods are all debit accounts.
No, on the manufacturer statement above.
Yes, this manufacturing statement, this is an internal statement, so there's not really debits or credits on this. Okay. But we can think about it as transferring as well. So anything we're using here, we'll go deep into the flow on that. But you really focus on the debits and credits for the balance sheet and income statement. And then in the future, we can talk through how you can kind of transfer these over. The point of this is just a high level overview.
Okay.
Yeah. Good question. But yeah, I think that's an important way to think of this too, is you're still going to be using the skills you had from before. So anytime we have an inventory account, it's going to be debited. And then when we're transferring it to another account, you credit, like, let's say we have beginning inventory or direct materials. When we buy more direct materials, we're going to debit it and credit cash. And then when that direct materials moves into work in process, you credit the direct materials because it decreases an inventory account, and you debit your work in process. It's another inventory account. So you're just increasing and decreasing different inventory accounts. So it's just an internal transfer of the inventory accounts. So this concept here of customer orientation is the fact that now that we have so much information and we know that customers have a higher expectation on products, we're going to use lean principles to continually improve our products. So what does that mean is companies are tending to release products quicker and then fail quickly to get feedback and then sell the upgraded products. So you'll see that's why like beta testing comes in, or companies will release products and know that they're not perfect and then give you refunds if you made a mistake on Amazon or something like that. The idea is it's better to get quick feedback in order to improve your product than test it a bunch, all to improve the customer experience. And one of the goals of managerial accounting is for us to improve the quality of our products. So we continuously seek to uncover any wasted costs so we can bring down the cost and increase the quality, and then encourage employees to try new methods to discover the cost. So you might like give bonuses to employees who are able to find ways to improve a product's quality or to lower costs. This is this concept of, so this just-in-time concept of manufacturing is what I just talked about. It's this flip of traditional manufacturing. So when we talk about like Ford, Henry Ford, when they developed cars originally, they just made a bunch of cars and tried to make them as cheap as possible and then hoped customers would buy them. Now there's so much product in the market, customers put in orders, and then the goal is to make the products as quickly as possible after the order. Because otherwise you just have a bunch of products sitting in a warehouse and it becomes very expensive to maintain the warehouse. So you complete the products just in time for them to ship to customers. That's the goal. There's this other concept called the value chain concept, where every process in the chain adds value to a product. So there's so many interesting concepts here, and I'm trying to, I know we're dumping a lot and I'm covering a lot right now. But how do you define the cost of a good? Like this kind of transfers into economics a little bit, is like, what is something worth? And there's a lot of ways to define worth, right? Like one of the ways is, what are you willing to pay for it? Like if an egg costs $20, you're probably not willing to pay. Like if it costs you $20 to make and a loaf of bread, you're probably not willing to pay the $20, right? So it doesn't make sense for you to make the loaf of bread, right? The utility of the good really drives the cost, like in economics. From a value chain perspective, though, like every activity should be adding value to a product, and then should it result in an increased price. And so we're like always balancing this, like what is a customer willing to pay? And then is an activity worth increasing the price of the product? And so you're always asking this as a business. Let's say you have a farm and you have chickens on it and you can make an egg for 10 cents. Well, you can sell the egg for 25 cents, right? So you make a 15-cent per egg profit. Well, what if you could use those eggs and some other ingredients to make a loaf of bread? And you could sell that loaf of bread for $2. The question is that effort worth what you could sell the product to? Are you good enough at it? Are you adding value? Well, you increase, let's say all these ingredients cost $1, and now you can sell the bread for $2. The value chain increased the value, like the service of the baking. And then what if a salesperson can make it look better or make the experience more enjoyable, and you can actually sell it for $3, or a marketing person. And then if you deliver the bread to someone's house, you can sell it for $5, right? So those eggs and all these ingredients that cost $1 through the value chain made the product worth $5. And then we ask ourselves, is the customer actually willing to pay that? And so every step of the value chain increases the perceived value of the product. We've talked about that. And then now this is getting very interesting. There's a lot of push to like corporate social responsibility and this concept of the triple bottom line. There's also something called the balanced scorecard. We'll go into all of this, but this concept of we shouldn't only be worried about the financial benefit of a company, but also how are they impacting the social and environment too? And there's actually a whole new method of accounting coming down on reporting on a company's impact to the environment because of all of these green initiatives. Any questions there? This is making you more aware of these concepts. These 101 courses, right, are supposed to be very broad. I want you to be familiar. You need to learn your definitions, cast a broad net, and then in your upper division classes, you'll go in a lot more detail into all of these concepts. And if you're interested in them, let me know. We can talk about them more. In all of your financial accounting classes and any accounting class, you're going to have to memorize your inventories, your ratios. So earlier you memorize them, the better. I've said this in our financial accounting 101 class. We had all these ratios. You're going to get them. You're just going to keep getting these the rest of your career. So just master these earlier rather than later if you're a business major. So nothing fancy here. I'm not going to talk to you about the math. It's basic division at this point. Just understand what it's actually measuring. So what is this measuring? High level. We want to know how quickly we go through raw materials. So how much do we use versus our average materials inventory? How quickly are we cycling through raw materials? That's a useful metric. Or how often do we have to purchase new rounds of raw materials? That's what the day sales and raw materials measures. So to re-summarize it all, what do I want you to know from this chapter? I'm going to go through it all over again very quickly. Understand what managerial accounting is and how it's different than financial accounting. Main difference is the users, right? External versus internal. Understand that we need ethics and that managerial accounting really can help you the real goal of managerial accounting is that you want to learn how to estimate information, plan, and track previous information to make it more usable. And that there's tons of good career paths. You need to know the difference between fixed and variable costs, right? Fixed costs don't change. It's your equipment cost, while your variable costs increase as your activity changes, and the difference between direct and indirect costs. Direct being traceable, indirect being non-traceable. Direct example is materials, indirect is your maintenance expense. You're going to need to know that how direct material, direct labor, and manufacturing overhead all track to product costs, and the difference between product and period costs. Period costs being your G&A, product costs being everything directly attributable or indirectly attributable to a product, and how those all flow through the financial statements. Here's a good example. Good examples that you can use to practice. And that service companies generally can use the same concepts. We talked about direct labor, factory overhead. Know what the difference between prime costs, which are direct material and direct labor, and conversion costs, which are direct labor and manufacturing overhead. And then non-manufacturing costs, which are those period costs. Understand that there's different flows for manufacturers and merchandisers. We're going to be mainly focused on manufacturers, which have raw materials, work in process, and finished goods. Right? And that shows the difference of the different balance sheets here, and how income statements might differ because now we have the cost of manufacturing. And then here's all the flow of manufacturing, which we talked about. So you need to understand all of that. And then understand the high level, some of the trends on lean orientation. What does that mean? And that we're focused on just in time and higher quality products. And that as you produce a product, you have to weigh the cost of increasing the value of the product with how you can sell it. So make the decision, do you sell the eggs or do you try to sell a full delivery service of bread? And then know the trend of the world trying to make businesses more socially responsible, and then know your ratios. That's what I expect from this chapter. So try to cover that at the very end. So if you want to go back, I'll separate that video and you can know this is what I need to take away. Okay, any questions? Michelle?
For the exam or midterm, how is it gonna be laid out?
It'll be multiple choice. The
Okay.
midterm will be multiple choice. And
Okay.
I'll make sure the day before that we cover every subject that's going to be on the midterm. So nothing will be a surprise. Yeah.
Okay, and is it gonna be the formula? Like how are we gonna use the formula?
The homeworks will help you practice.
Okay.
Yeah, the homework and quizzes will help you be substantially similar to what you expect to get on the midterm.
Okay.
Good questions. Julio?
Yeah, I just want to know, on your slides, you have like C1, P1, and A1. I just want to know what those stood for.
Yeah, it just goes back to the learning objectives. Conceptual concept, so the concepts,
Okay.
how to analyze, and then how procedural.
All right.
Like in practice. Yeah, good question. Any other questions? Keep them coming. Can be about anything on these slides of the class. If not, I can give everyone a break till 10:20, and then we'll go over chapter 2. Chapter 2, we're going to be talking about job order costing next. So that's going to be here. It's about the same duration and about a little less slides, but we're going to be talking more about how do we use all of these concepts and apply them to specific jobs. I have a question. Is the final exam not multiple choice? No, each exam is, so the midterm and final exam are multiple choice. Your weekly quizzes are not, right? Your weekly quizzes could have long answers in them as well, but your final exam and your midterm are only going to be multiple choice. So let's take a break. let's come back at 10:20. I think I will be able to finish this lecture by 11, and then I'll leave it open for people who are trying to add to the class or have any questions. If you didn't show up early, if I didn't take roll for you, stay on. I'm going to go take care of that right now.
Professor?
Yeah. Yeah.
Sorry, quick.